The stock market keeps going higher every single day. Is now the time to plug our nose and buy, or should we wait? Or are there some stocks in this market that are actually still producing some great opportunities? That's what we're going to find out in today's video. Let's jump in. So it's no question the market as a whole has done really well, but we talked about this in the last video. There's certain pockets of this market that are really doing the heavy lifting. Naming a few, of course, could be like Nvidia, Broadcom, Microsoft, Apple, Amazon, Google. It's the mega techs, the big ones, right? The big stocks seem to be pulling the most weight, which has been a theme in the last few years. But are there some opportunities in some of the more beaten down areas? Take a look at healthcare plans, which have gotten killed here recently, or energy stocks, which have experienced some downside as well. Consumer defensive stocks have also not been very popular either. Insurance companies are down. And so in this video, I'll be taking a look at both the holistic level as well as some stocks that I'm watching in this market right now. So if you enjoy this type of content, make sure to hit the thumbs up button, subscribe, and let's take a look at some stocks. And the first up on the list today is going to be Google. Is Google a buy after this big jump higher? Well, my answer may actually surprise you. The answer is yes, but I still think that there's some better timing that we could do, and specifically I'd be waiting for a pullback on this one, but I still think that Google shares are actually relatively undervalued to its history. Let me show you why. On the stock box, we just added a new feature. The trailing 12-month PE of Google currently is somewhere around 21.22. Now, that may sound high until you realize that the rough 3-year average is somewhere near a 26 to 27 range in terms of a trailing 12-month PE for Google. So in some ways, the valuation on the stock is actually lower than it usually is. Meanwhile, the forward PE of Google is actually around a 18 or 19 level, which is still also below its historical average. So while the price action looks a little bit technically overbought here in the short term, especially when we apply our extension zones indicator, you can see we are topping out here at the upper limits of this extension zone. And so, yes, I do think that on a short-term basis, Google stock is a little bit overextended. But Google has a reason for being valued in the 20s, in my opinion, with a rising revenue chart that we can see here, profit margins that also look very good, and net income that's rising. Why is this stock out of popularity right now? Well, all the rave around ChatGPT and all these other various, chat AI bots, Perplexity, Grok, Gemini, all these different things, which, by the way, Gemini is owned by Google. They all present a new challenge that Google has not faced maybe ever in its history, which is the dominance and almost monopoly that Google search has had for the last 2 decades. ChatGPT and its relative peers sort of level the playing field when it comes to the search business. Side note, this article was posted December 15th, 2022, and we all know how far AI has come in the last few years. It's been massively adopted very quick. And so Google's shares have gone mostly sideways for quite some time because investors are worried that ChatGPT and all the different algorithms out there being introduced with AI are set to potentially take some of that dominance from Google in terms of Google search. And the big criticism of Google search now is that Google search gives you links to go find out information, and ChatGPT just gives you the answer. And so people are greatly moving in the direction of using these ChatGPT models and all these different AI chatbots to answer their day-to-day questions, and perhaps that is cannibalizing to Google search. Why do I say cannibalizing? Well, because Google is in on the chat stuff, right? They've got the Gemini AI model, which is, by the way, a really strong one. And actually something interesting here is that on Polymarket, which company has the best AI model by end of 2025, Google's Gemini actually leads the way. But despite them having the potential best AI model, does it even matter if Google search is going to get taken down as that sort of monopoly? Well, what I've just presented to you is the bear case for Google. And while that is certainly some valid criticisms, I think that this uncertainty around the stock presents a longer term possible buy the dip opportunity on Google. Again, despite these criticisms, we still see revenue and net income rising very nicely. And this uncertainty in the stock is producing what I believe to be a nice overall discount in the valuation of the company. Now, it should be stated that Google has earnings coming out on Wednesday of this week. And so I am looking to see if the stock potentially has a downturn in terms of short-term momentum. If we get a pullback, this may produce a buying opportunity in my personal view. However, I do already own some shares. I currently own 200 shares of Google, and I'm sitting on a decent profit overall of around 16% on my shares at this time, with an average share price of $165.45. And while this is a good size position, I actually want to get my trade size on Google to be bigger. So if earnings come out really strong for Google, then of course I could do well in the stock and just continue to hold it, and actually may even sell some covered calls, as I think we're getting a little bit stretched here in the short run on a technical basis. But again, I'm going to be cautious and sell those deep out of the money because I think that the stock is not super expensive relative to its history. Another stock that I've not talked about on my channel before is Accenture. Accenture is a interesting stock here to me right now because we have had a pretty good size sell-off. You're talking about a stock that is down about 28%. At one point was down 31% from its highs. And I've seen some criticism here, some uncertainty around hiring consultants, right? Which is of course Accenture's big thing. If there is some, stalling in that due to a lot more efficiency through AI, needing less of hiring going on, right? A lot of people being able to solve their own problems with AI stuff. I do think that, this is a reasonable, sell-off in terms of the market saying, hey, you know what, we can use AI to assist us with things more so than we need to have experts come in and do stuff. And so that does level the playing field for companies like Accenture. However, I do still think that there is plenty of room for experts, especially as, new trends develop, new industries form. And I imagine Accenture with its powerful, kind of vehicle for finding and hiring the right people for the right jobs, I do think that they'll still play a role in the future. So this is another company that is kind of interesting to me. Here's ticker symbol ACN or Accenture, and their trailing 12 month is currently coming in around a 22.5 reading compared to the 3-year history of about a 27.8 range. And you can see this in the chart as well. The PE ratio has come down alongside the stock price. And I do think that this potentially presents a nice longer term buying opportunity on this stock, and that the risk to reward, which is at the end of the day all that matters, is potentially worth taking for me. Accenture is also sitting around a longer term level of support around this $275 per share price. And if we were to shoot to an overextended downside move once more, especially if the broader market turned down, this might actually be a stock that I look to pick up. By the way, the tool that I'm using is called the A1 Stock Box. And if you don't have a copy and would like to explore it, we are offering trials down below in the description of this video. If you want to try out the tool, all of its different features, there's a ton of stuff here if you're interested in exploring financial data for stocks that you like, or if you want to view our technical screener, you can take a look at our 52-week high and low scanner, our market breadth indicator, our pullback setup scanner, our market sentiment tools, and our AI-generated headline sentiment as well for your favorite stocks. For example, you can select by sector and view latest AI-generated stuff on popular stocks in the healthcare sector. Speaking of healthcare, take a look at the ETF for the healthcare sector. You can see XLV here moving lower once more. And this sector has just been beaten down. In fact, actually going into this year, I thought we would get a sharper reversal in healthcare stocks. And while we did initially get some uptick in healthcare this year, it's mostly rolled back over. There's uncertainty around the administration potentially coming down hard on some healthcare names, and just a general lack of momentum, which plays a big role in stocks. Stocks that have been doing well a lot of times typically continue to do well, and stuff that is just bottom of the barrel and keeps getting sold into is almost like a popular short trade, or just not interesting to the investors out there who are looking for those high flyers. So when I look at an XLV, which is the ETF for healthcare, I actually see some potential value here. For example, take a look at ticker symbol UNH. This is UnitedHealth Group, and what we can see here is that the stock has gotten absolutely killed this year. And, there's been a number of reasons. There's been allegations of, uncertain activities and things like that. But we have to look under the hood a little bit here and ask ourselves, is this stock, truly, going to zero, or is there some good risk to reward in some potential longs? My personal opinion, and it is my personal opinion, not financial advice, is I think it's the latter. I think that there is some opportunity to scoop up some shares at discount prices. And specifically, if we take a look at going back to my study here, the trailing 12-month PE ratio for UnitedHealth Group coming in at 11.8. The 3-year average is at 22.6. So if you liked this stock at any point, if this is a stock that you think has potential in the future, right, you're talking about a very discounted price if things can stabilize from here. There is a big if in there, right? Because it's not certain that that will happen. There's no guarantee it will go back up. But in terms of a risk to reward profile, UNH to me looks very attractive. We're talking about a forward PE ratio of 10.85 compared to the 3-year 18.5 historical average. So both of these metrics would indicate that the current valuation on the company is very low relative to recent averages. Profit margins have remained mostly stable for UNH, and we still do have consistently rising revenue and net income. However, to be fair, revenue growth is slightly below its 3-year average, which is worth mentioning. So then the question with a UNH situation becomes, do you buy it now or do you wait for it to technically reverse? And to be fair, there is a case to be made for both scenarios. The way I like to buy and sell stocks is actually through the wheel strategy, which is, if you're not familiar, it's essentially where you sell cash secured puts until you get assigned. Once you're assigned with the shares, you sell covered calls. And if that's above, your understanding of options, no worries at all. Basically, I am looking to only buy the stock if it were to dip sharply from here, and I'm going to sell a cash secured put in order to do that. Why would I sell a cash secured put? Well, I collect a premium for doing so. So even if the stock goes up and never comes down to my level, I still get paid for selling that option. So I'm interested in potentially selling some puts on UNH, but specifically you'll see this indicator that I have on here. It's the A1 extension zones. And I use this for a number of reasons, but one of the big reasons, and by the way, this will be linked in the description down below if you want to get access to this indicator. One of the big things I use it for is actually options trading, where I'm looking for volatility to be expanding, right? That big expansion in volatility typically coincides with some nice juicy premiums that I can collect as an option seller. But since we've recently been in a pretty tight range on UNH, the premiums are not nearly as attractive as they were over here. Shoulda, coulda, woulda sold a lot of cash secured puts after this big drop, but I did not. We can also take a look at some of the other drug manufacturers in the space. For example, Pfizer. This would potentially be a value name that I'd be interested in picking up. Although the stock is not particularly cheap, if we did get a large share price downside move, it potentially could be worth picking up in my view. Another stock that I've talked about previously on the channel and am now very interested in is Abbott Laboratories. Medical device companies are something that I really like and want to invest in personally because, of course, I think that they have the potential to really go far with all of this AI stuff, right? Technical surgeries being done by automated robots and more devices, more tools and things to power doctors into the future, I think is a huge area for potential investment and profit margin expansion. So I think companies like Abbott or Medtronic, for example, have the potential to do very well in the future. And while Medtronic is not particularly oversold at this time, something like an Abbott Laboratories might meet my criteria for a possible entry. Specifically, what I'd like to do with Abbott Laboratories is, with this rising volatility, I'd actually like to sell a cash secured put out of the money below the current share price level. Essentially, I'm bullish on this stock and I think it has more upside. Here's a look at the weekly chart, which is in an overall upward trend and looking a little bit oversold. In terms of a trailing 12-month PE ratio, we've got a 15.6 rating compared to the historical average around 32.5 in the last 3 years. It's a pretty good discount to its usual valuation. So this very well may be something on the watch list for me coming up soon. Another Another stock I've been flirting with the idea of potentially getting involved more in is Adobe. ADBE is the ticker, and of course this is it's sort of a competitor in some ways to like a Microsoft, where this thing builds all sorts of different tools, Google, Microsoft tools, where they have all these different fleets of different tools that help consumers and businesses. I think that Adobe has gotten absolutely oversold in my personal view. We're looking at a trailing 12-month PE on this stock that is currently around 23.5. The 3-year average is up near the 48.5 level, so we're getting some huge discount. The question is why? Well, again, it goes back to AI disruption. We're getting these green value points because, again, it's saying, hey, the stock box here is determining, well, this is trading currently at a valuation that is much lower than its usual valuation. And so what could be going on here? Well, first and foremost, the stock price kind of stinks. This thing has been in a range bound to downward market from the highs that it made in 2021. We're talking about a stock that is down 47%. So if you've held it since then, you've lost half your money, and it's been years. So Adobe has been sort of a dog in terms of a lot of people's accounts. I know that this stock was very popular in 2021, very exciting, and they built some really powerful tools. So is this thing completely ruled out for the future? Is this something that you should just stay far away from? Well, of course, you make your own decisions, but for me personally, I think there's some value here that actually could come into play. So what I may choose to do is essentially pick up the shares if we were to get a move back down to these previous low levels. The way I might express doing this is by, you guessed it, selling a cash secured put on Adobe share price. However, with a share price in the 300s, you're talking about a commitment when selling one contract of puts, you're talking about a $30,000 plus commitment. So what I could do is I could do a bull put spread, which is essentially where I sell a put and also buy a further out of the money put and collect the premium net credit from the two options. If the options jargon that I use on this channel confuses you, then check out our totally free options course. I'll leave a link in the description down below if that's something that you're interested in exploring, but like I said, it is completely free, no strings attached. If you're interested in options, we've built out a full kind of tutorial on what I do in the options market, and it is completely free to access. Just put your email in there and we'll send it over to you. And remember that if you want to try out the Edge Finder, we'll also leave a link in the description. Make sure to subscribe for more stocks, and we'll see you next time.